6 decades ago, African and Asian countries were faced with a shared desire to remove colonial rule and boost economic development. Since then, many Asian nations have risen to become export-driven, economic powerhouses. Japan and South Korea adopted state-led development models, investing heavily in education, infrastructure, and industry. In 1961, China was among the 10 poorest countries in the world. Within 20 years, the country had shifted from a command economy to a market-oriented system. It now attracts massive foreign investment and is the world's factory. Other Asian countries are also major players in global manufacturing and trade. After the Korean and Vietnam Wars, much of Asia benefited from decades of relative political stability. Neither the Soviet Union nor Asia's former colonial powers intervened militarily in Asian affairs. Africa has not been so lucky since 1960. Britain, France, Russia and the United States have sent forces into African countries, directly or indirectly, on dozens of occasions, to support their business and political interests. China has financed infrastructure projects across the continent. The African Financial Community Monetary Zone is criticized as a French neo-colonial project, which is inherently unequal and rooted in exploitative practices. Unlike their Asian counterparts, most African nations have not been able to industrialize and still rely on commodity exports. Nigeria, South Africa, Kenya, and Ghana have seen economic growth, but not at the pace of their Asian counterparts. The lack of infrastructure and basic services, combined with climate change, political instability, frequent conflicts and widespread corruption, have hindered Africa's economic performance. Structural adjustment programs imposed by the IMF and World Bank in the 1980s and 1990s led to economic liberalization but also caused unemployment and economic stagnation in many countries.